Hi everyone. Today we are going to focus on the big bus chart in accounting, which is widely used by companies during the COVID-19. A big bus is an accounting trick by manipulating income statement to make poor result look even worse, to make a future result appear better. Well, a big bus is not illegal in practice. It is still considered as an unethical accounting tactic, as some commentators suggest that depreciation or amortization of assets should follow a prescribed schedule. To better discuss this phenomenon, we will start from analyzing some real-world examples and then list the advantage of each approach. At the end, we will compare two of them and discuss the more preferable approach from regulator perspectives. So I will illustrate the big bus specifically with the first real-world example. Santos Limited, which is the second largest independent gas producer in Australia, announced last year that it expects to recognize an impairment in oil and gas assets of about 700 million due to revised oil price assumption. A change in assumption is resulting from the effect of the COVID-19 pandemic on lower demand in energy market, which caused a lower oil price in 2020. However, it is not the first time that Santos announced lower oil price assumption in recent 5 years. As found in 2016 and 2017, there are also a large amount impairment expense in each year, which is about 0.9 billion and 1.5 billion respectively. Those impairments are recognized with one reason, which is that Santos focused a lower oil price in future than last assumption. These impairments are considered as big bus because the carry amount of assets are valued based on oil price focused. So it could be recognized a large amount of impairments in 1 year, especially during a long-term depreciation in crude oil market, to make sure it can disclose a growing net profit in the next few years. As you can see, with the positive earning effect by the big bus in the previous year, the stock price might recover and trade even higher.
Hi, in terms of my part, I'm going to talk about two different cases of big bus phenomenon. My first case is Samsung Electronics being accused of big bus accounting, especially in the first quarter of 2008. It's quite obvious from the histogram, the average first quarter expenditure on marketing and management went up by 35.19%, which means the company spent money on marketing was too large compared to the previous quarter. This makes people suspect that Samsung attempt to rid off certain laws aggressively. If you look back and see the report in 2008, there is a quite famous investment company in South Korea, HMC Investment Security, who is engaged in providing financial service. They took the forecast by expecting 25 billion net revenue for company operating profit in the first quarter of next year. In addition, the disclosure from the former Samsung Electronics vice president, when the companies realize the financial condition is through a losing phase, and based on the company reputation, the management believe further substantial loss in the future will not affect the potential investors, so they will take a one-time charge, clean up their asset, accelerate the expense that incurred in the next quarter, and defer revenue, keeping them out of the current quarter. So in the next year, the financial statement will show an inflated number of profit, which makes the result look more attractive to increase the number of potential investor and shareholder. The second case is about the big bus earning management with the company consolidation. The story started in September 2010, also with a Korean company, ABC Corporation. They acquired 100% share of an international saving bank. This table below shows the financial statement before the consolidation and the year right after. We can see that the loss allowance rate during the rate of change increased by 1.5%. The rate of provision for the credit loss increased from 1.18% to 3.52%. But on the other side, the bad expense increased from 9% in the 2009 to 33%, a sharp change in 2010, which can grab the result from the statistic number. The company attempt to dispose of as many bad debt as possible during the consolidation year. They want to take the bank asset, especially the goodwill, off the book and minimize the remaining value of the acquired company, which can lead a lower price paid by a new shareholder. After 1 year's change, it's not surprising that all the increasing value we mentioned above finally back to the conventional value. That's two cases above describe how company earn the benefit from a big boss accounting. And let's move on to the next question. Thank you.
In this part, I will talk about the advantages of granting managers the flexibility to charge impairments for assets. As we know, the assets are recognized to be expected to bring future economic benefits to the business. The primary goal of accounting for IAS 36 impairments of assets is to ensure that the value of assets stated in the statement of financial position would not exceed their recoverable amount. And under Accounting Standards Codification, Topic 360, when events or changes in circumstance reflect that the carrying value of the assets may not be recoverable, long-lived assets require the impairment test. The goodwill impairment is more likely to be used by companies when the earnings are expected to be weak, thereby decreasing the test payments. Based on Jordan and Clark, significant studies indicate that big bass earnings management has a certain relationship with goodwill impairment. Under Statement of Financial Accounting Standards 142, managers are provided with a high degree of discretion on reporting whether and how much goodwill has been impaired. In addition, the flexible use of assets impairments can prepare for the future profits of the enterprise. When the enterprise deals with some assets, as long as the price of the impairment provision is higher than the price of depreciation, the book value of the assets will be smaller than the market price and generate a surplus. Meanwhile, another advantage is that the enterprise can flexibly using assets in impairments to cover the forced trading when an enterprise wants to erase the deceptive valuable assets. The relevant accounting personnel will build some for sales, and this sales subsidiary will be indicated on the corresponding bill. In this way, companies can cover up these false receivables with a lot of money. In conclusion, there are three main advantages of granting managers the flexibility to charge impairments on assets. They are reducing the test payments of enterprise and preparing for the profits of enterprises and covering up some fake transaction. Yeah.
Now I'm going to talk about the advantages of requiring companies to depreciate or amortize their assets according to a prescribed schedule. First, from the going concern perspective, one of the main benefits is that it helps companies to record the correct carrying amount of the assets in the financial report and have a clear sense of the use of the asset's value during its entire lifespan. Depreciation or amortization according to a prescribed schedule contributes to a more reliable and relevant financial report as it represents the true carrying amount of the assets. The lack of appropriate depreciation and amortization will overall understate the carrying amount of the assets. Also, it supports the company to compare the expense incurred by the asset and the revenue generated in the same financial year to evaluate the profitability of the assets. Then the management board could decide the necessity of this kind of assets in the future. Big bets is considered an unethical accounting tactic because it makes bad income even worse in order to make future financial results look better. It is not helpful in building a healthy relationship with external parties, as they may be suspicious about the irregular financial analysis. On another hand, big bets will cause shareholders to panic about the company's profitability. They will be eager to sell their existing stocks, resulting in a decrease in the stock price. Consequently, the reputation of the company will be influenced negatively. Depreciation or amortization an asset according to a prescribed schedule is more easily to manipulate, as big bets need to be taken under the guidelines of GAAP. Otherwise, the company may engage in the fraudulent activities. Furthermore, the last benefit is that by recording depreciation and amortization according to a prescribed schedule, the company will be able to compare the depreciation or amortization expense with their competitors to see whether it can improve the utilization of the assets to decrease the depreciation or amortization expense every year and extend the lifespan of the assets in the future. This will make the company more competitive in the home industry.
For the last part, I will focus on the more preferable approach from a regulatory standpoint. In terms of company internal controlling, the main advantage of depreciation and amortization following a prescribed schedule is that the company can easily match the revenue and expense generated by the depreciable asset. However, listed companies are more likely to use the big boss approach as they focus more on providing investors with the most favorable earning information. A big boss is not necessarily illegal, as it can be carried out effectively within existing accounting rules. This approach can be valid, but it has a reputation for being used too much to manipulate the amount of reported earnings. When profits are manipulated to a higher degree, data from the company may lose reliability and relevance because of too much financial guessing. As a result, investors should be aware that if the overconfident managers fail to report these write-downs, earnings are overstated, which will result in inaccuracy in financial statements. Reductions of the information environment will exist as financial statements cannot reflect the underlying economic conditions of the company. Investors should be especially skeptical when a company has a history of repeatedly taking a big boss and then posting exceptional strong earnings in subsequent periods. Therefore, companies depreciating or amortizing their assets according to a prescribed schedule is more preferable than a big boss from the regulatory perspective of view. To conclude, big boss grants managers the flexibility to charge impairments on assets, which has a certain relationship with goodwill impairments, thus reducing tax payment. It also reflects the prudent principle and accounting standards as managers make provision according to the current market condition. Companies depreciate or amortize their assets according to a prescribed schedule that benefits the carrying value of assets recorded in the financial report and evaluation of the profitability brought by the asset. Companies can compare depreciation or amortization expenses with their competitors to see if they can improve the use of their assets. Big boss is a legitimate accounting technique if used on a limited scale. Using big boss many times may result in lack of reliability on data, and companies should use this trick under the guidance of GAAP to avoid fraud. Investors need to pay more attention to the disclosure of the big boss in the statements and pay attention to the frequency of use. That is all our presentation. Thank you. The reference list I show as below.